Hello, everyone. Today on the final bar, my guest is Jeff Hughes from JWH Investments in Minneapolis. We'll talk about some of the charts top of mind in his process. The S&P accelerating a bit to the upside, recovering some of the pullback in the afternoon, closing just above 4,200. But small caps really the leadership today, pushing to the upside. It's an interesting space to pay attention to. Leadership today: industrials, financials, materials. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very sunny Naples, Florida. Thanks for joining us every weekday after the close as we focus on the markets using data visualization, focusing on the charts, focusing on what price can tell us about sentiment, about momentum, trend, belief, behavior, all of those things that are represented in price. Tells us a lot about the market conditions. If you had one thing and one thing only, focus on the message of price itself. It's interesting. I mentioned we're down in Naples, Florida this week visiting some family, and it's been interesting, as I'm sure many of you can identify with, when you're used to having a very set routine in a very specific physical place. Now it's been my home office for a year and a half or so. It's an adjustment to do it somewhere remotely, but as usual, you find some new ideas, find some new inspiration, and just having a different environment, different place to look at things seems to refresh automatically. So good life lesson in there somewhere. Continuing on with our schedule. So as I recording this, we're actually just after this show around 6:30 Eastern. We'll have our latest episode of The Pitch. We recorded that a bit earlier today. It was Aaron Swenlin from Decision Point, Mary Ellen McGonigal from MEM Investment Edge, and Danielle Shea from Simpler Trading. We had so much fun talking about their 5 stocks picks each, and we compared notes about the markets overall. Touched on so many things in 45 minutes. It's going to be worth watching for you. Also, this week, we're almost wrapped up with our Chart School Idea Generation special series of events. 5 different experts providing their scans that they use on stock charts. Go to stockcharts.com/chartschooltv for more information on each of those experts. Next week, we'll be taking Monday off for the Memorial Day holiday. Coming back on Tuesday, we'll do our normal Monday routine, hitting on the macro, the micro, and the sectors in the middle. Wednesday, Dave Landry from davelandry.com. Thursday, Craig Johnson from Piper Sandler in Minneapolis. Let's continue on with our market recap today. As I mentioned, the S&P, sort of bouncing up going into the close overall, closing just above the 4,200 level. We've really been revolving around there. If you remember, 4,210 was sort of that line in the sand when we came off of the all-time highs. Breaking that to the downside was one of the initial warning signs that we may be, moving a little bit further down. We really haven't since then. We've recovered very nicely from that pullback, about a 4.5% pullback on the S&P so far. So very much in line with July pullback. The NASDAQ flat, the NASDAQ composite, the NASDAQ 100, more the mega cap version of that, down about 1/3%. So technology really lagging behind the S&P today. Mid caps and small caps especially up a lot more than the S&P, which is essentially flat. Looking at fixed income markets, yields back up a little bit, up to around 161. And again, the growth versus value, do you go back into some of those technology names that have pulled back? Arguably one of the biggest headwinds and or tailwinds to that thesis is interest rates, right? Higher interest rates are going to, in general, make it tougher for the growth stocks, signifying more of a tougher environment ahead. So higher rates today, pullback in technology sort of fits the bill in the short term for that. Gold flat for the day essentially, but precious metals otherwise up just fine. The USO, our proxy for crude oil prices, up a little bit, and energy stocks just up 0.25% today. Cryptocurrencies for the most part down today. Bitcoin really chopping around the zero level, currently around 38,770 as we record the show. Let's look at a chart of the S&P, just update on where we're at. Then we'll go back to some of the other themes and movements today. By the way, a little later in today's show, we're going to do a segment called Getting Sentimental. We'll update on some of the sentiment readings. We'll look at the VIX call put ratios and some other things to update on what they are telling us about the overall environment. The S&P chart, to be honest with you, I mean, we are back at all-time highs. We're within the range of those highest high days from about a month or so ago, 3 weeks ago. And so overall, we're really at the ceiling so far. We're at the established ceiling around 4,200 to 4,250. You know, last couple times the S&P has attempted to get above that level. It has failed. It's given back. The last time we were here, we ended up pulling back around 4.5%, right down to the 50-day moving average, right down to trend line support. If we would have a similar pullback from here, that would put us around 4110 in that sort of environment. But overall, you have charts that are sort of working. And I think from my bottom up screening, when I'm looking at stocks making new swing highs, and I have a general universe of US stocks trading above, like I think a 10 billion market cap or something. I had about 100 stocks earlier today that I came up with. When I ran that screen, I had about 5 stocks making new 3-month lows. So that is continuing to certainly overweight in the bullish category in terms of stocks, you know, able to make swing highs versus swing lows. The S&P itself, though, not able to do that yet. And I think that's the real question. Do you have enough strength from charts like financials and some industrials and materials that have had really good runs? Do you see a buy-in from some of those technology stocks that have pulled back, things like Tesla and others that have really pulled back a little bit? And obviously Tesla and consumer, some of those other names, do they move more like Ford does, you know, sort of following through to the upside, making new all-time highs or new swing highs? That's what I think you would need to get the S&P to break to new all-time highs to get above 4,250. Until then, I think we're still in consolidation mode. When I look at the chart, I reflect on the fact that for the last month, we really haven't gone anywhere. Now, granted, we've moved a lot vertically, but directionally, we're still about where we were. We were talking about 4,200 and other levels back here quite a ways ago. We're still sort of in that same range. So overall, we have a clear sort of area to think about. We have the clear resistance around 4,200 to 4,250, which we are now approaching. We have support around 4,110, which would be the lows from trend line support and lows the 50-day moving average. Coincidentally, it's very interesting, and I misspoke earlier. 4,110 was that low from mid-April that I was talking about. It would be interesting to see that if we would get a pullback, we have the support level from mid-April, we have the 50-day moving average, and we have trend line support taking the long-term lows, all coinciding with that 4110-ish level, which that could actually end up being a pretty important level to pay attention to. Looking elsewhere in terms of leadership today, you know, again, we were, as I mentioned, we were recording the pitch earlier. It's coming up right after this broadcast this evening on Thursday. And as a quick preview, was a lot of growth we were talking about. The number one sector that the 3 experts had selected to overweight was technology. And I'm looking at a day like today when the S&P doing fine, right? Coming up a little bit, but it was the leadership from financials, leadership from industrials, from materials. Those are the top 3 sectors. It wasn't tech. It wasn't communication services. Those now again, communication services did fine. Those are further down the list of leadership. So certainly the cyclicals pushing higher today. What was underperforming today? Utilities down 0.6%. Certainly a defensive sector, followed by consumer staples. Also generally a defensive sector down about 0.5%. Tech, third from the bottom, 0.3%. Healthcare, fourth from the bottom, 0.2%. Looking at some other charts and themes, and I'm looking at the industry leadership, sort of a mishmash of things in the top 10, a couple of materials groups that you often do not see in the top 10 list coming up here. Also aerospace and diversified industrials. And that's where some of the, the industrial sector doing well today, reflected by some of those names. You know, aluminum stocks and others makes me think of some of those charts within materials that we've touched on before. Nucor, NUE, we were talking about earlier this week. A steel name, but interesting to see some of those stocks that have had really good runs into mid-May, now pulling back a little bit. I was mentioning gold stocks earlier with my panel of experts, and have had, if you look at Newmont Mining, a really interesting breakout above the August high around 70, and you can see it pulling back a little bit just in the last week or two, but overall still a pretty decent breakout, I would argue, over a nice basing pattern for a 7 or 8 month period. So might be interested, again, I find materials, it's such a small sector weighting wise. It's not names that you may be familiar with, but the good thing about screening for stocks making new swing highs, new swing lows, looking at stocks making new 52-week highs and lows, just looking for stocks in established uptrends and downtrends, a lot of times that will point you to a group like that or a sector that you may not normally be looking at. Automobiles in the top 10 today, and I mentioned Ford's had a nice pop to the upside here. Tesla is certainly the largest of the automakers now. But if you look at the traditional automakers, Ford really bouncing to the upside. The electric F-150 sort of been the story, among other things, here recently. Overbought now for the first time in a couple months, rotating above that March high, which I think is significant. The real question for me would be, after this run, those last couple of days has been sort of vertical, right? And you're up 7% again today. I get a little concerned when we become overbought after these huge runs higher. It makes me think of this January period where we gapped higher a couple times, a big explosion to the upside. Not unreasonable for a stock to pull back just a bit. So there may be sort of a pullback scenario here. You can see that a number of times when a stock like Ford sort of has a nice jump higher like that, a little bit of backing and filling is completely healthy. A lot of times expected and can give you a potentially good entry point. So maybe a chart to watch there. On the downside, brewers, which haven't been a bad group, but that was the weakest of the 106 or so Dow industry groups. Also, two groups within technology, and this is why tech was one of the worst sectors today: computer hardware, software. These are stocks like Apple, Microsoft are all represented in these groups. So certainly some pain in tech today, but overall the potentially reemerging along with the other growth areas of the market. We need to take a quick commercial break. We'll be back with my guest, Jeff Hughes. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. As a reminder, we'll do another mailbag segment on Friday's show. We would love to answer one of your questions on the air. Shoot us an email with any questions that are coming up in your process, and we'd love to address it on the show. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. On our YouTube channel, just put a comment below the video that you're watching. We would love to hear from you. Hope to answer one of your questions on Friday's show. Also, as a reminder, StockCharts TV on demand is unleashed and ready for you. We did such a great job, I think, as a team putting that together. I'm proud of the work of our graphic designers and producers and so many that worked to make that, to elevate our content, including our recently award-winning documentary from the floor of the New York Stock Exchange. We had a fantastic win from the Telly Awards, highlighting our documentary series called The Big Board from the floor of the New York Stock Exchange. You can check that out and all the other content at stockchartstv.com. I want to welcome on my guest, Jeff Hughes. Jeff is the founder of JWH Investments. He's been a regular guest on the show, always brings some thought-provoking charts. Jeff, welcome back.
Hey, thanks for having me, Dave.
So small caps is where we're going to start. This is an area that certainly led today, right? The S&P up just a little bit above the zero line, but small caps and then mid caps pushing higher. There's been a bit of a reemergence. What is the chart telling you?
Well, it's an impressive chart, I think, considering the fact that, it was just weeks ago that people had written small cap off for dead. A lot of pundits talking about a head and shoulders top and looking for it to break to the downside. And I think we've seen just the opposite occur really over the last 10 trading days or so, as the formation looks to have turned more into a symmetrical triangle, a 5-point triangle formation, which tends to resolve in the direction of the prior trend trajectory. And as we can see, the prior trend was up. And so, the judgment at this point is that we should see a resolution above the upper boundary of the symmetrical triangle and a resumption of the trend to the upside. The real question is, what if it doesn't happen? And why do we have confidence in this resolution to the upside? And, obviously, if we did see a reversal to the downside, we could potentially see a more extended triangle, a little bit different pattern develop. But I think a breach of the lower boundary would definitely call into question this analysis. What gives me confidence is the momentum structure that was just penetrated to the upside. And if you look at the lower panel of this chart, what we've really done is we've created, a momentum sort of model based on the moving average. So we're using a 50-day exponential moving average, and we're simply measuring the deviation above or below that moving average, as represented by the zero line with the horizontal red dashed line to kind of look, to reflect the 50-day moving average. So, I think the deviation to the upside here and the breakout from that momentum structure is something that gives me at least some confidence and insight that the likelihood or the probability of the upside breakout is definitely something that we have some confidence in at this point.
It's amazing how small caps have really hung in there and now potentially rotating higher. It's a great chart. Chart number 2, we're rotating a bit to talk about breadth. What are the breadth conditions from your perspective?
So we look at a number of different models, but one that's really caught our attention lately is net advancing volume. And what we would note in the 2 charts that we're looking at here, on the left is NYSE cumulative net advancing volume. That's advances less declines. And we've made a new all-time high. And this is really just looking at the last 9 months of data. And if we move to the right side, that represents the NASDAQ cumulative net advancing volume. And likewise, we've made a new all-time high. It's been a little bit different sort of development in that, especially as NASDAQ stocks really over the last 3 to 6 months have kind of treaded some water, especially with the big leadership names. But now we are breaking out with, buying pressure. Really what this alludes to is that under the hood of the market, there is buying pressure and it's showing up in the net advancing volume.
It's a great transition to slide 3. We're looking at cumulative net new highs, so another measure of breadth. What about this one?
So similarly, and we're tracking this compared to the S&P 500, which is kind of the red area chart behind the white line. The white line represents all U.S. stocks on a cumulative basis. And again, we're looking at net new highs here. And as of yesterday's close, we've made a new all-time record high in cumulative net new highs across all U.S. markets. And that is another confirming breadth statistic that really just shows that the market's internals, whether it be new highs representing breadth, whether it be net advancing volume, whether it be momentum, these internals are all turning up. They're making new highs. And it confirms to me, at least my suspicion is that the market will resolve to the upside and begin to make new highs and continue its advance. That's been our thesis at this point, and we believe that will resolve in that direction.
Jeff, we only have about 30 seconds. I love the charts. I love the take. When you're thinking of a market at new highs or right around new highs, you showed the strength and breadth and the strength from the small cap index starting to move higher. If you had new money to put to work today, what sort of areas in the market would you be looking at very quickly to express that thesis?
Sure. Well, we like industrials and we like cyclicals in general. You and I were talking offline, and I mentioned FedEx is a name. Well, there's a small cap name that kind of parallels that, and it's Atlas Air Worldwide, symbols AAWW. It's a long haul air cargo company, typically overseas cargo. And so this is another stock that made another new all-time high today. And it's really tough not to like stocks that are making new all-time highs.
Never confuse the top of the page with resistance. I was taught by one of my early mentors, and I think you've made the case for that very well here, Jeff. Jeff Hughes, thank you so much for joining us as always. Stay safe, be well. We'll talk to you again soon.
Thanks, Dave. My pleasure.
That's Jeff Hughes. Jeff is the founder of JWH Investments in Minneapolis, JWH Investment Partners. It does such a great job. And again, I think when you see those 3 charts, you see how that's laid out. It's hard as an oftentimes bear, it's hard to argue with breadth conditions, holding in there so well. And I think that's one of the things that has prevented, me and others from getting too climactically negative during any sort of pullback, because you have advanced decline lines, that continue to push higher. You have advancing volume, that advancing volume, as Jeff was illustrating, continuing to move higher, right? You should get bearish or should certainly consider becoming a lot more bearish or a lot less bullish when those lines start turning downwards, not when they're continuing to push to new highs. Great take from Jeff Hughes there. Our next segment is called Getting Sentimental. We love to do on Thursday. A lot of sentiment readings come out once a week. Usually you're updating the Wednesday to Thursday timeframe. So Wednesday after the close is a good time to check in on some of the popular sentiment readings, see where they're at, and see what we can do in terms of drawing some conclusions on investor sentiment, on where people are leaning, where people are voting with their capital, and also voting with their words through survey data. As a reminder, this series called Sentiment Indicators, this chart list is part of the free chart pack called Dave Keller's Morning Coffee Routine or something kind of like that. If you go to your dashboard, go to your chart list, and at the very bottom, there's a gray button that says Manage Chart Packs. You'll see David Keller's Morning Coffee Routine. You are welcome to access that. This chart list, among many others, is included in that, included for all StockCharts members. We're going to start with the VIX. And again, the VIX is an interesting one. I have this purple blue shaded area that I had kept updated for quite a while. I sort of stopped updating it because we sort of completely became disconnected from this level. This is sort of the 20 to 22 range. And for much of 2020, for the second half, and then the first quarter of 2021, we continued to bounce off of the 20 level, or 20 to 22 or so, and would bounce higher. And more often than not, right, low volatility tends to coincide more with bull phases, and especially market tops. The volatility can get relatively low. Volatility tends to increase during dislocations, during downturns in the market. And again, it's not definitely saying it's a negative turn. There's not a perfect inverse correlation between the VIX and the S&P, but there tends to be an inverse one, because when the market sells off, that tends to be more volatile, more anxious, more fearful. That's why this is called the fear gauge. If you're measuring fear, we don't see it right now, right? The fact that the VIX is once again below 20, actually below 16 once again, or in the 16 range, around 1674 today. You can see that lines up very similar to where we were in mid-April, where we were again in early May. So we're kind of lining back with some of those extended periods before we pulled back for a couple of days. But overall, we're sort of in the lower VIX range. What's interesting is this range of 20 to 40, which is where we spent the second half of 2020, early 2021, was actually very different from the year prior, right? In 2019, you fluctuated from around 10 up to around 20. That was really the normal range for volatility. So as we talked about back here in April, when we broke to new lows, does that tell you the market's topping? Not necessarily. It might just tell you we're in a different volatility regime, a period of lower volatility, more in line with 2019. And given the persistence of this trend, given the consistent uptrends that you're seeing on a lot of charts, you wouldn't be, it makes sense to me the volatility is very low. That's how the market has felt. And again, compare what you're seeing in stocks versus things like cryptocurrencies and other particular parts of the market. But overall, the average stock is in a fairly decent trend. So volatility relatively low. I would love to tell you there is a particular level at which that tells you that that the market's most likely topping. That's not been my experience with the VIX. It's all about where we're at relative to where we've been recently. And now we're at the lower end of the range. That does not mean the volatility can't continue lower into the low double digits or high single digits even. Chart number 2 is looking at the AAI survey data. This is the American Association of Individual Investors, and whether they're bullish, bearish, neutral on stocks for the last six months. When I initially brought this chart up earlier today in preparation for the show, I dialed up our data team saying, all right, guys, there's some problem here because we've had 3 weeks straight where it's an identical level. So we confirmed it with the AAII. It's actually been very, very similar the last 3 weeks. Now, this is interesting because the bullish reading had been above 50% about 6 to 8 weeks ago. That had been one of the highest readings ever. When we're above 50%, those are extreme reading. Now, granted, other times we've gotten up into 50, 60 plus. But if you look at the last 5 years, this is at the upper end of the range that we've been in by far, essentially telling you we're at euphoric levels relative to what we normally have been. If you look at what's happened, though, in the last 6 to 8 weeks, is we've now come down. Bullish readings consistently around 36%, 36.5%. Bearish readings fairly consistent around 26%, 26.5%. Now there's a consistent spread of about 10% bulls minus bears. And so what that overall tells you is we're at a fairly consistent opinion, right? Sort of bulls are positioned for that, bears are positioned for that, is what that is telling me. There's no huge change, there's no huge capitulation, some big euphoric rise or desperate move down. We're sort of stable, which is again, if you want to look at a chart of stability, maybe FedEx, the chart that that Jeff was mentioning earlier, charts like that, Facebook breaking to new highs. RY was a stock, Royal Bank of Canada, I was looking at earlier this week. Just inconsistent uptrends, and that's what the sentiment reading I think is sort of confirming. We did see a big jump in the name exposure index, and it's interesting as the AAII survey has been relatively stable. The name exposure index has been pretty volatile recently. It's been interesting to watch. About a month ago, 4 to 6 weeks ago, we were above 100%, meaning leveraged long, meaning, and this is another survey with money managers telling you how long or short they are equities. So they were over 100% long equities. Again, net all the respondents. Then we very quickly, within a 2-week period, went from about 103% down to 43%, which is a huge swing, about 60% going back down, telling you investors were lightening up. Money managers were tapping the brakes in a big way. All of a sudden, we've bounced right back up this week to around 68%. So around 43 to 68%, that's a 25% swing of money managers going back into the market. Ridex flows, by the way, at some of the lowest levels we've ever seen. They jumped up a little bit last week, but coming back down to 0.1%. This chart is plotted inversely, by the way, just to illustrate more in line with what the other survey data would tell me. So the fact that the Ridex flows are so low basically tells you individuals are really all in on the bullish and sector-based funds as opposed to cash and bearish funds. Finally, the put call ratio is essentially mid-range. There isn't a huge acceleration in the put call ratio. You can see other times when we've made new highs, you see the put call ratio is very low. This is the total put call ratio. Here's the equity only put call ratio. At times has been down around 40 to 0.36 up to 0.40. We're still around 0.47. So we're not at sort of that capitulation level. We're not at all-time lows, which would imply there's potentially more upside to be had for stocks. That is our segment, Getting Sentimental, focusing on some of the survey data and positioning data. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1, taking from our Getting Sentimental segment, is looking at the name exposure index. They bounce higher in the name exposure index, which I would argue is overall pretty constructive. I would say during a healthy bull market phase, you'd want to see money managers exposed to equities. When they lighten up quickly, when they start tapping the brakes, that's when I would be concerned, telling you that it's the quote unquote smart money is starting to unwind a bit. Still relatively low. Again, in a persistent uptrend, you'll have a reading above 100%, but heading in that direction, which I would argue at this point is probably more constructive than not. Chart number 2 to illustrate some of the charts breaking higher. Ford Motor Company, ticker F, breaking to new highs. We highlighted this earlier in our market recap segment. If there's a concern on Ford, it's that it's gapped higher now today, up about 7%, a couple days of moving higher. If you look back on this chart, when you've had that scenario, some gaps higher, some accelerated moves to the upside, the stock becomes overbought. It is completely reasonable on this chart or on any chart to expect a bit of a pullback. So I'm not sure I would want to chase something like that here. I would be very much looking for an actionable pullback. And after a run like this, the more often than not, you see a pullback, and then you see the price bounce right back higher. And it's all the investors that missed that initial move higher, the breakout of a basing pattern, looking for an entry point. A bit of a pullback might provide just that. Finally, highlighting Facebook today, outperforming the market yet again, up 1.5% when the S&P was up about 0.1, 0.2%. Completing, I think, this continued rotation higher. This is a classic basing pattern. The high last August, connecting again in November, connecting once again in mid-March, and then breaking above it, testing that from above a number of times, bouncing off the 50-day moving average, rotating higher. If I had a portfolio of charts that looked kind of like that, I probably wouldn't feel too bad about myself, with the stock making new 52-week highs, relative strength making a new multi-month high. Overall, I think that's setting up well, and that's a stock that's actually not overbought yet. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the Final Bar. As a reminder, shoot us an email with any questions. We'd love to hear from you and answer your question in our mailbag segment on Friday's show. Our email is thefinalbar@stockcharts.com. Special thank you to Jeff Hughes from JWH Investment Partners for joining us from Minneapolis today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe, be well. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.